But first, I thought we'd take a look at the stock of the day, TechnologyOne, which has been a bit of a favourite here for quite a while, but hasn't come up on the call for a couple of months from memory. TechnologyOne reporting a near 20% rise in its half-year profit, up to just over $33 million. Company seeing an acceleration of customers moving to its SaaS service. Shares taking a bit of a hit in morning trade, down 2%. Moreland, I know it's a bit of a Teaminvest wealth winner over the years, hasn't it been? So
it has been.
What do you think of TechnologyOne?
Since we started 14 years ago.
Yeah.
So I think it's a fantastic company.
Yeah.
And I'm a shareholder, so I'm absolutely biased.
Right.
And I've been a shareholder for 11 years.
Right. Oh,
so
okay.
And I've added all the way through. Right. So first ones I bought were at 98 cents.
Right.
And I've added through. It's
right.
been spectacular. One of the things that really stands out about T&E is its earnings stability.
Yep.
It's actually got the highest stability, I think, of any company in the country. It's at currently running at 99.1% stable. In other words, its earnings growth is linear, and that has been linear for 20 years.
Wow.
So what you want, from our perspective, is when we're looking at a company, the return you get from an investment is all about earnings first, like what are the earnings growing at, and all things else being equal, that will dictate what dividends you get and what capital growth you get over time. PE is market sentiment, that goes up and down, obviously, that's the sentiment, but the earnings are what really counts. So what you want, as Buffett says, you want a company that has stable earnings, because if it's stable, I can be much more confident in predicting what my results will be. So at the moment, T&E is not cheap, it's on a PE of over 40. Which is not cheap. So it hasn't been smashed as much as a lot of the other tech stocks. It did come down for a while, but it's coming up again now. So it's not a screaming bargain. We're showing it returning about 11% a year at the current price, which is still pretty good in this market, by the way.
Right.
Super safe company, no debt, very, very good management. We've got owner mentality. The founder's still chairman.
Right.
And he is retiring, but it'll be the major shareholder still. But it's very, very much an owner mentality business.
That's a much better chart than most other technology.
Well, even
market,
that's the sales. That's the price chart.
Yeah.
So that's just market sentiment still.
Yeah.
And there's been no reason why it should go up and down a lot, really, other than if you're re-rating it on the PE basis, saying, well, we're now in a interest rates are rising, therefore I want a higher rate of return for various risk levels. T&E is at the very low end of the risk level. Okay. Like super safe.
Right. So a bit over $10, $10.20.
And they're also growing very strongly in the UK.
Right.
So they've now got a successful business in the UK, which they've built the hard way, not by buying something, but by setting up.
And they only transitioned to SaaS relatively.
Oh no, they've been doing it for years.
Right. Okay.
They were very early in developing dedicated SaaS software, which I'm thinking is 10 years ago.
Oh, okay.
And then what they've done is, as they've perfected that, they've progressively moving over all their existing clients, which are, by the way, viewers don't know, it's mainly councils, that's one of their biggest segments, and Catholic schools and universities. So quasi-government all the way through. So no credit risk. And they've been transitioning all their existing clients, and then all new business for the last few years has been on the SaaS model.
Right. Okay. So at 10.20.
Yeah. Well, I'd say
be buying.
Yeah, I think so. If you're happy with 10 or 11% return, which it's going to be reliable, I think. But the PE could come back.
Right.
It's still on a high PE.
Okay. All right.
I'll say yes.
Yes. Okay. Mark.
Yeah. No. It has pretty much the opposite characteristics of most technology companies, to be honest. So. It's got no debt. Really, the only headwinds I could find was potentially rising employment costs. But look, they've increased their dividend very consistently every year. The revenues are up 21%. They had a record half one. Profit. They're looking at their profit margins improving up to 35% over the next over the next sort of 6 to 12 months as well. Look at given that tech's not really a sector that I'm obviously massively keen on, risking at the moment. But as I said, the characteristics of this company are very, very non-tech-like. The PE was about the only concerning thing I could really find. I'm just not loving the fact that it's around about that 40 mark. But look, everything's going in the right direction. They've got and then like I said before, they've got no debt. So, but then from a risk-reward point of view, there's an interesting trade setup here where probably pretty happy to buy, you know, around the $10 mark, because, you know, pretty much if it breaks through those 2 recent lows there, you know, it's a pretty cheap stop really, around about 5 odd %. So I think you can definitely have a half allocation here at absolute minimum, and just sort of stick to your stop just in case, you know, the market decides to throw a tantrum again. But yeah, no, look, it's the sort of thing that it's all the traits of a company you're looking for at the moment. If it wasn't involved in technology, it'd probably it'd actually probably be slightly higher, because I think it's just been painted with the brush. Broadly, there's a lot of that baby being thrown out with the bathwater at the moment. And this one, so
a good solid stock for the future.
I think the other thing to think about too, is as an investor, is forget about market gyrations unless you're a trader. If you buy a quality business like TE or CSL, if it drops 20%, whatever, you don't have a stop to take you out, because the business is solid. You only want to sell it if there's something wrong with the business, because it'll come back. And you're absolutely safe. So it's not. I wouldn't suggest you try and trade it. This is a buy and hold stock, unless something changes.
Are there many stocks like that?
There's not a lot, actually. I'd say like CSL, Cochlear, which is too expensive anyway. But the healthcare, Fisher & Paykel Healthcare, there's a few in health that I think are very, very solid long term, and they have been. I mean, CSL has done over 20% compound return since listing, which is spectacular. That's the average. So if you forget about market gyrations, if you just held it, it's been fantastic.
And Fisher & Paykel as well, which has been...
And TNE.
Right. Okay.
Fisher & Paykel extraordinarily cheap at the moment.
It is. It is.
Particularly historically.
All right.